Good afternoon, everybody. My name is Corey Galinsky with Severn Bank. I'm also a past president of the Maryland Mortgage Bankers and Brokers Association. I'd like to thank you all for tuning in to this webinar regarding what is a closing disclosure and going over some sections of the closing disclosure. Without further ado, what exactly is a closing disclosure? For those of you that are refreshing yourself or new to the industry, the closing disclosure is a 5-page form that describes the critical financial information of a mortgage loan, things like loan amount, interest rate, fees, taxes, closing costs, and all other items. So a very, very important document. As some of you might be asking, well, where did this document come from? A few years ago, the financial regulations were changed, and the Truth in Lending Disclosure and the HUD-1 settlement statement were merged to create the closing disclosure. The question of when is the closing disclosure provided? If you think about the transaction like bookends or like covers of a book, the loan estimate is the beginning of the process. And that's what we hope things or estimate things will look like at the end of the process. And then the closing disclosure is what things actually are at the end of the process. The loan estimate is issued within 3 days of the loan being originated, and the closing disclosure is issued within 3 days of the loan closing. So that gives you a little bit of background about what specifically the closing disclosure is, where it came from, and what it is provided to the client. It's very important to know that if certain items do change on the closing disclosure, then a new closing disclosure will have to be provided to the client. And then further, if specific items change, like if you change the product from a fixed to an adjustable rate mortgage, or if the rate changes by more than 1/8, then we are required to redisclose and then restart that 3-day period for the closing disclosure. So we'll get into the nuts and bolts of the actual closing disclosure here. Again, it's a 5-page document, and if you look at the top, it explains to the client that this form is a statement of final loan terms and closing costs, and it advises the client to compare the document with the loan estimate. If you look on the left-hand side, you'll see some critical dates: the date that the closing disclosure was issued, the closing date, and then the disbursement date. These dates traditionally should be different. The date issued should be 3 days prior to the closing date, unless it's an updated or clerical closing disclosure that's been issued or supplemental. And the disbursement date could be the same day of closing. If it's a refinance, it could be a few days after closing as well. But very important documents to make sure that they are accurate and correct. You have your settlement agent information listed and your property information, as well as sale price information. You'll also have some transactional information regarding your borrowers, and we want to make sure that everything is complete and accurate, ensuring that the borrower names, addresses, and seller names, addresses, and lender names appear correctly. Lastly, you'll have your loan information, and like we just discussed, the loan term, the purpose, the rate type are all very critical information, because if that loan term does change from a fixed to an ARM or vice versa, then we would have to wait the additional 3 days and reset that clock. Moving further down the first page, you'll see that the loan amount is provided to the client, and there's also a section here that advises the client pretty clearly and conspicuously, can this amount increase after closing? So we're providing critical information to a client, for example, regarding can their interest rate change after the closing, can their monthly principal and interest change after the closing. So all these are itemized very clearly for the client throughout this first page of the closing document. What page 1 really is at a high level is just an overview of the transaction in general. So the first third of the page will be broken down into the loan terms. You'll see the projected payments for the estimated total monthly payment. You'll also see a section for prepayment penalties, which are by and large prohibited in the state of Maryland. If there is a prepayment penalty, that'll have to be listed in this section. You also have a balloon payment section. If this loan were to have balloon features, whether it was a 12-month, 5-year, 15-year balloon, that would have to be noted here very clearly to the client as well. Here you'll see a projected payments table. Notice in the projected payments, it'll spell out that same principal and interest, but it'll also then provide the client's first insight into what the mortgage insurance or what the escrows will be on that file. And then it'll provide the client with a estimated total monthly payment as well. Notice that you have payment calculation tables that show years 1 through 7, and then you have years 8 through 30. This provides the client with an estimate of when that mortgage insurance will drop off and what the estimated total monthly payment will be once that occurs. Down here, there's also a description of what is included in that escrow payment, which will be taxes, homeowners insurance, as well as other items, including that mortgage insurance. Lastly, at the bottom of page 1, you're going to see a compilation of closing costs, which will be loan costs and other costs, and it will also subtract any lender credits or other credits provided to the client. That'll be further described in page 2 in a little bit of a deeper dive in the closing disclosure, but this is just a summary line of the closing costs. And then you'll have the borrower shown their first view of what the actual cash to close will be on their closing disclosure. This includes several specific calculations from page 3, which we'll go to in just a little bit. Okay, moving forward to page 2. So page 2 really is a more specific description of the actual costs for the borrowers and the sellers in the transaction. What you'll see at the top left will be the loan costs, which are the origination charges if we have application or underwriting fees by the lender, broker, or bank, as well as any points that might be paid or discount points. Moving down, you will have services that borrowers did not shop for, which is in section B. These services will be things like an appraisal fee, credit report fee, flood, tax monitoring, tax status. It's important to note that this is a zero tolerance section. So because the borrower was not able to shop, we cannot alter or increase these fees to the borrower after we issue the loan estimate and then provide the closing disclosure. So for example, if we provide a loan estimate and the loan estimate says the appraisal fee is $400 and we don't have a changed circumstance, then that closing disclosure should list that the appraisal fee was $400. And that's what zero tolerance means. There's no tolerance for alteration. So things like lender charges, broker charges, affiliate charges, mortgage insurance charges would fall into this section. Section C would be the section that borrowers did shop for. These would be things like your title fees. If the borrower picked out their own title fee, and that would not be subject to a tolerance because you would not know in advance who the borrower would be picking for their title company and what their fees would be. So it's on your best estimate. The bottom half of page 2, for specific other costs, you're going to see things like the recordation, transfer, homeowners insurance, that'll be padded. You'll see any padding for prepaid interest as well as for the beginning of an initial escrow account. So it's important that the client understands not only the bottom line on page 1 of what their closing costs are and what amount they need to bring to the table, but also what compiles those specific costs. A lot of times clients will have questions if they're refinancing about what is being accrued for taxes or for insurance versus what is currently being held at the current servicer. The payoff would provide you some of that information, as well as this closing disclosure would be the other end of that. The bottom of page 2, you're going to see some other information regarding HOA or any real estate commissions if it is a purchase, and those would be split accordingly pursuant to the contract. And in this example, the seller will be paying all of the fees. Notice that each section is summarized nicely, so the borrower can see at an individual line what the prepaids are, for example, what their property taxes are, and then they can also see in general what the total prepaids are as it relates to the closing costs on the loan. So the general overview of page 2. We'll now move on to page 3. And page 3 does a good job of just summarizing and balancing the transaction for the borrower and for the seller. you'll see at the top of the page that there is a section regarding how we calculated the specific cash to close. And notice again, it refers the loan estimate and the charges that the borrower was presented at the loan estimate, and then the charges at the final closing disclosure. And then it also will describe to the borrower if those fees changed and costs changed and where those costs might have changed. So very useful. In previous disclosures, it would just be a new paper on top of an old piece of paper. And in this form of disclosure, it provides the client an understanding of what they were provided at the estimation or beginning of the loan and versus the actual costs and what was the difference. You'll see the breakdown of cash to close here at the initial loan estimate, as well as the final closing disclosure. And then as we move down, you'll see, as you follow along, first what's due from the borrower at the settlement. So this is a purchase loan. You'll notice that the property costs $180,000 and the closing costs are just over $9,600. We have some small adjustments for HOA, and that's where we get our total due from the borrower at closing. As we balance out the borrower side of the transaction and move from Section K to Section L, you'll see that this section is comprised of the loan from the borrower. So our loan is $162,000. We'll reduce the $10,000 deposit provided by the borrower, any credits from a title company. You might have a seller credit in here, you might have a lender credit in here, and any other adjustments. And that's where you'll see total already paid. So our total paid is our deposit, our loan amount, and any other credits. And then our difference will be our borrower's cash to close. And that's our borrower's side of the transaction balanced on page 3. We'll move over to the seller's side of the transaction, look at Section M. You see that the seller has agreed to sell the property for $180,000, as we have on the borrower's side. You see a minor item for HOA dues, and that gets us our balance of $180,080. And then you'll see what's due from the seller in Section N. So as we balance out M and N, you see that the seller does owe a first mortgage of $100,000, and they also have some closing costs on their side as well as a credit. And so the total due from the seller is $115,000, which provides the seller against their balance of $180,000 and 80 cents. I'm sorry, $180,080 cash from the seller to the seller of $64,414.96. All right. So that again, page 3 just balances out. Left-hand side is our borrower. Right-hand side is our seller. Bottom left is what will be due or will be provided to the borrower. And bottom right is what will be due or will be provided to the seller. And in this instance, the borrower is bringing $14,147.26. And in this instance, the seller is receiving $64,414.96. Okay. Moving on to page 3. Page 3 is additional disclosures and loan features. A lot of this is pretty clearly presented, but is the loan assumable? Yes or no? Is there a demand feature, meaning can the lender call the loan at any time? Yes or no? What will the late payment be? Is there a negative amortization feature to the loan? Will your lender accept partial payments? And then there's also an escrow breakdown. This is a pretty important section for your clients to understand how we arrived at where the escrow will be and what the impounds are, and then how the cushion was set up. And then lastly, we have page 5, which is calculations and contact info. On the top left-hand side, you will see the APR on the loan. This is the actual costs over the loan, and that's expressed as an interest rate. So whereas on the first page, you'll see the interest rate of the loan, this is the interest rate of the loan that takes into account the actual costs of the loan as well. So when a lot of people are shopping for the lowest possible rate, they should take into account obviously the total costs to acquire that rate and not just the rate alone. So this page provides other pretty interesting calculations: total payments over the life of the loan, the finance charge, the amount financed, and then the total interest percentage, or the total amount of interest that you will pay over the loan term as a percentage of your loan amount. So 69% of the total payments will go towards the interest on this loan. And then at the bottom, you have your contact information. Obviously, you have your lender information for your bank or your broker, and you have your buyer and seller agent, as well as your title company information. If this was refinanced, most of this would be blank, save for your lender or broker information and your title company information. Again, this must be provided, and the borrower must acknowledge it 3 days prior to settlement. There is a section for the borrower to acknowledge it, as well as other forms such as electronic delivery and confirmation of receipt with the client. But that is a general high-level overview of what is the 5-page closing disclosure. And again, remember that the closing disclosure is a form that's meant to describe in high level what the costs, what the terms, and the specific transaction balances are. And then each page gets a little bit more specific with that. And it's critically important that we provide this in a timely manner to the borrower, no less than 3 days prior to the closing, so that we can meet or exceed our commitments. But other than that, I want to thank you for taking the time, and thank the Maryland Mortgage Bankers and Brokers Association for allowing me a few minutes to talk to you all about the closing disclosure. So thanks a lot, and have a great day.